Right now, as you're watching this, money is being created. Not printed, created, out of thin air. And the craziest part? It's not happening at some government mint or the Fed. It's happening at your local bank branch, the one with the drive-thru and the bowl of lollipops. Most people think money comes from somewhere, that it's got to exist before it can be loaned out, that banks are like vaults, holding cash from savers and lending it to borrowers. But that's not how it works. That's never been how it works. And once you understand what's actually going down, you can't unsee it. Let me show you something. In 2008, the global financial system almost tanked. Banks were going belly up, governments were freaking out, and in the chaos, central banks did something wild. The Federal Reserve created $4 trillion. The European Central Bank created almost 3 trillion euros. They didn't tax anybody, they didn't borrow it from China, they just made it, typed numbers into a computer. And suddenly, trillions of dollars existed that hadn't existed the day before. But here's the thing. That's not some special move. That's just how money works, every single day, at every bank. The 2008 crisis didn't reveal some secret trick central banks can pull when things get dicey. It revealed what's been happening all along. And if you've ever taken out a loan, you've been part of it. Let's say you walk into a bank and ask to borrow 10 grand. You need it for a car. The bank looks at your credit score, your income, your job history. Everything checks out. They approve the loan. Now here's the question. Where does that $10,000 come from? You might think the bank takes it from their vault or from someone else's savings account. But they don't. They don't move money from one place to another. They don't call up another branch and ask them to wire over some cash. Instead, they open up their computer system and they type the number 10,000 into your account. That's it. The money didn't exist before. Now it does. The bank just created it. By making the loan, they created new money. This isn't a metaphor. This isn't me hyping it up. This is literally exactly what happens. In 2014, the Bank of England put out a paper straight up saying this. The reality of how money is created today differs from the description found in some economics textbooks. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. Created. Not transferred, created. Now you might be thinking, hold up, that can't be right. If banks could just create money whenever they wanted, they'd be printing infinite cash. They'd never lose money. They'd never go bust. But banks do fail, so something's got to be stopping them. And you're right, there are limits, but they're not the limits you think. Banks can't create unlimited money because of something called reserve requirements. In the old explanation, the one taught in textbooks for decades, it worked like this. A bank needs to keep 10% of its deposits in reserve. So if someone deposits $100, the bank keeps 10 and can lend out 90. That $90 gets deposited somewhere else. That bank keeps 9 and lends out 81, and so on. Money multiplies through the system. Nice and tidy. Except that's backwards. That's not how it goes down in sequence. Banks don't wait around for deposits to make loans. They make loans first. The loan creates the deposit. The deposit doesn't create the loan. The real limit is demand. How many people want to borrow money? How many of those people are good for it? If nobody's borrowing, no new money is being created. And if tons of people want to borrow and banks think they can pay it back, massive amounts of new money flood into existence. Between 2000 and 2007, in the run-up to the financial crisis, the amount of money in the U.S. economy almost doubled. Not because the government printed it, because banks lent it into existence. Let's zoom out and look at what this means in practice. In most developed economies, somewhere between 90 and 97% of all money is created by regular banks through lending, not by governments, not by central banks, by everyday banks making everyday loans. Cash, the physical bills and coins you can hold in your hand, makes up less than 3% of the total money supply. Everything else is digital. Numbers in accounts, and most of those numbers were created the second someone borrowed them. Right now in the United States, there's about $21 trillion floating around if you count all the broad measures of money. Around $2 trillion of that is physical currency. The rest is bank deposits. money that was loaned into existence and hasn't been paid back yet. Because here's the other part. When you pay back a loan, that money disappears. It's destroyed. If you borrow 10 grand, the bank creates 10 grand. When you pay back that 10 grand, those dollars vanish. They don't go into the bank's vault. They don't get added to some stockpile. They just stop existing. The interest, though, that sticks around. That's the bank's profit. So in a weird way, the money supply is constantly churning, being created with every loan, being destroyed with every repayment, and growing over time because people keep borrowing more. If this sounds nuts, that's because it kinda is. The system runs on one very specific assumption, that not everyone will want their money at the same time, because if they did, it wouldn't be there. This is what a bank run is. It's not that the bank lost the money or blew it on something dumb, it's that the money was never fully there to begin with. Most of it only exists as numbers in a ledger, and if everyone tries to turn those numbers into physical cash at once, the whole thing falls apart. During the Great Depression, thousands of banks went under because people panicked and demanded their deposits. The money couldn't be produced because it had been loaned out. Except, again, it wasn't really loaned out in the sense of being moved somewhere else. It was created when the loan was made and no longer existed in the form people wanted. This is why deposit insurance was invented. Not to protect the money, to protect the belief in the money. As long as people believe their deposits are safe, they don't all ask for them at once. And as long as they don't all ask for them at once, the system works. So what does this mean for you, for the economy, for everything? First, it means that money isn't scarce in the way we think it is. There's no fixed pie. The pie grows every time a bank makes a loan, which sounds awesome until you realize what it actually causes. Inflation, skyrocketing asset prices, wealth inequality. When banks create new money, that money doesn't spread evenly. It goes to whoever gets the loan. And who gets loans? People who already have assets, people who can prove they're good for it. People buying houses, starting businesses, investing. The new money jacks up the price of assets before it trickles down to wages or consumer goods. This is why housing prices have gone through the roof in most Western countries over the last 30 years. Not just because there's a shortage of houses, though that's part of it, because there's been an explosion of mortgage lending. More loans means more money chasing the same assets. Prices go up, and rising prices make banks more willing to lend because the collateral is worth more. It's a feedback loop. Second, it means the economy is inherently unstable. Growth depends on people borrowing. If people stop borrowing, the money supply stops growing. And if people start paying back loans faster than they're taking out new ones, the money supply shrinks. That's deflation. That's a recession. Not because anything real has changed, because the flow of new money has stopped. Central banks try to manage this by setting interest rates. Low rates get people to borrow, high rates make them think twice. But they're not controlling the money supply directly. They're trying to influence how much money banks create through lending. It's indirect, it's imprecise, and sometimes it doesn't work. Here's the uncomfortable part. If money is just created when banks make loans, why do we treat it like it's the sacred, limited resource? Why do governments stress about deficits and debt when central banks can create currency with a keystroke? Why do we accept that millions of people are barely scraping by while trillions of dollars are conjured into existence to buy houses and stocks? The answer isn't economic, it's political. It's about who gets to create money and who benefits when they do. Right now, that power sits with private banks, and they create money for people who want to borrow, not for people who need it. Some economists argue this is fine, that banks allocate money efficiently because they have to get paid back, that government-created money would be wasted or cause runaway inflation. Others argue the system is fundamentally broken, that money creation should be a public utility, not a profit-driven machine. Both sides have evidence, both sides have blind spots. But here's what's not up for debate. The money you use every day, the money in your bank account, the money that makes up 97% of the economy, was created out of nothing by someone clicking a button and approving a loan. It's not backed by gold. It's not backed by government reserves. It's backed by a promise. The promise that you'll pay it back. And as long as most people keep that promise, the whole thing keeps running.
So the next time you check your bank balance, remember, those numbers aren't representing something stored in a vault. They're just numbers. Numbers that exist because someone, somewhere, borrowed them into reality. And if that makes you feel uneasy, good. It should. Because money isn't what we've been told it is. And the system that creates it isn't neutral. It's a machine. And like all machines, it has winners and losers. The question isn't whether it works, it's who it works for. Thank you for watching. If this opened your eyes, don't just leave. Like the video, share it, leave your thoughts in the comments, and subscribe to the channel. The story of money isn't done yet.